All right, here we go. Hey YouTube, it's Matthew Decker with Leveraged Wealth Management and Cash Value Life Insurance Reviews. We specialize in cash building life insurance products. And today we've got a policy review for you. I have a team member here with me, Brady Watkins. And Brady, you brought a specific policy that you wanted to look over today because I guess we're getting a lot of questions on it. So tell us which one it is and let's go from there.
Great. Yeah. So, we've been doing this for a few years now. And as, questions come in, as people call in, we get a few certain carriers and products specifically a lot. And this IUL product is coming up a good amount of times. And it's funny because the carrier is more populated in the whole life space, but they're wanting to do a lot of IULs here with this product. So we have the Penn Mutual IUL product, which is the Accumulation Builder Flex IUL. So my first question, topic of conversation is just, in general, what are your thoughts on Penn Mutual as a carrier?
In general, I think Penn Mutual is a great carrier. They've had a lot of really good products in the past. They're a stable company. It's a mutual company, which a lot of people like to tout the benefits of a mutual company. For those of you who don't know, a mutual company is just where the policy holders are the owners of the company. And so the line of thinking goes, if the policy holders are the owners, then the decisions that are made by the company should benefit the owners, which are also the policyholders. So the theory goes that your interests are aligned. And I think to most of the time, that's the case. So nothing bad to say about Penn. I like Penn.
Right. And they've been really reputable in the space for a really long time.
Yeah,
so that's
absolutely.
Definitely got something going for them there.
Yeah.
And let's get into the product here. We get a ton, like I said, of people already seeing this or asking about it because one, it's a big company. People have heard of Penn Mutual before. And two, there are a lot of Penn Mutual agents who are wanting to dish this product for one reason or another. The main things that, I've seen is questions about specifically the indexing options here. So I just want to hand it over to you. What is kind of, standing out to you, the pros, the cons? What do you like? What do you not like about their indexing options?
Yeah, so let's just kind of go through it one at a time here. I've got it pulled up on the screen and we'll share this for you so that you guys can see it. But when I look at this Penn product, the first thing that I see is the caps are not super high. And that's a common theme on this particular index universal life insurance policy. So we do have this high capped S&P account that sometimes we see being used on this Penn product. And we have a cap at 10%. Well, if 10% is your high cap S&P account, it's not a very high cap.
Right.
And so the fact that it has to say here high cap, I'm instantly going to know, okay, well that must be different than their normal S&P account. So what is different? Well, the cap is higher, but then they also have this asset-based charge. So they're going to charge you 75 basis points to have a higher cap. And on the face of it, I mean, that's not the worst thing in the world, right? If this was the highest cap in the industry, then I would say, great, it's a high cap S&P account. But the fact remains, it is not a very high cap when compared with the rest of the industry. I'd say it's average to below average, actually. So if you're going with a company that has a below average high capped S&P account and they're charging you to use that account, it's not the best that's out there from an indexing standpoint. And really, pretty much everything with this particular product is tied to the S&P. So they have their normal cap, which is 8.25. They have their high cap, which is at 10, which we just talked about, but they charge you 75 bips to use it. They have this high floor account, which gets some exposure. They drop your cap all the way down to 7, but they do guarantee that you're at least going to get 2% per year, which sounds good on the face of it. A 2% floor is better than a 0% floor. But the amount of times that your credit would fall above the 7% is way more than the amount of times your credit would fall between 0 and 2. And so I'd rather have the upside than the downside.
Yeah, and I think you touched on a really important part on the caps. And if you're just looking at the caps by themselves, or rather this product by itself in a vacuum, you could be convinced that this was a good deal. I think you could. And that's why it's so important to see products for what they are in comparison to the industry. Because if you had an agent, selling you this and saying, hey, this is a good cap for what it is, it would be reasonable to, believe them.
This is why you always do your homework, right? We never show just one option unless we're so far away from making a decision that we really just have to kind of show starter options. Then maybe we'll just show one option to try to narrow down what the goals are. But if you know what your goals are, if you know what you're trying to do, this is why you look at multiple options, because you get to see how do these companies compare to one another. So that's what I would say about the index options. Everything is S&P based, number one. The caps are relatively low. Number two, if you want a higher cap, they charge you for it. And you don't have to do that. You don't have to do business with the company that plays the game that way. So that's what I'd say about the index accounts.
And so just to summarize here, what would you want to see change about these indexing options for you to really say, this is actually a good group of options?
I would love it. Yeah, I would love to do tons and tons of business with Penn Mutual because they are a mutual company. They're highly rated. They've been around for a long time. In order for me to feel really comfortable recommending them as kind of like a first line, like a 1A option, I would need to see more than just S&P, because all they have is S&P. They have S&P uncapped and S&P capped. So I need to see more than just the S&P, and then I would need to see higher caps that don't come with a fee. Those would be the two things that I'd be looking for on the indexing part of this policy.
Yeah, I think it's worth saying that the indexes do come with guaranteed bonuses, which you can't say the same for a lot of carriers. I think that's true. That's a plus for the indexing options, but it probably doesn't outweigh the bad.
I would agree. Yep.
Going off to the next set of really questions that we get is mainly about how their loans work. When you're looking at this, what's standing out to you and what's favorable to the policyholder and what's not?
Yeah, great question, Brady. When it comes to policy loans, there's really two main types of loans. And if you've been around the channel for any length of time at all, you know that we harp on those. So you have your traditional loans, which of course Penn Mutual has. It's a good reputable carrier, and they do provide you your standard traditional loan. And the way that standard traditional loan is going to work is inside the first, typically it's like 10 years, but I actually think they do 5 years. So yeah, in the first 5 years, they're going to charge you 5.7% to access your dollars, and they're going to credit you back 1% less than the 5.7 because this is an adjustable rate. So basically you have a 1% net cost loan. After year 5, policy year 6 and beyond, those two things equal each other, and it's essentially a wash loan, which those are great wash loan provisions. These are actually probably the best wash loan provisions in the industry because it happens in year 6. Most companies will start their wash loan actually in year 10. And so, that's a big benefit of this particular product. If you want to use the wash loan, you get it in year 6. What most people will end up using this policy for, though, are going to be the indexed loans. And so we also talk about this a lot on the channel. We are huge proponents of index loans that are fixed, not variable. And we are huge proponents of index loans where you get to control where your money is allocated. Another way to say that would be if you use the index loan, some companies try to dictate where your money is invested. And so let's kind of read through this loan provision here from Penn Life and see where we fall. So it's an index loan, which is good. Index loans are charged interest at a fixed loan rate of 6% in all policy years. So that's one of two boxes getting checked. It's a fixed loan in all years. It's 6%. That's great because it's a variable that we know exactly how to account for. We put in 6%. It doesn't change. So it's a variable that doesn't change. Okay, the amount of the loan is placed in the indexed loan account by way of the holding accounts. The indexed loan account offers interest growth potential in 1-year segments based on the performance of the S&P 500 index adjusted by a participation rate up to a cap set at the segment start date. Okay, so the first thing that we talk about is a fixed loan rate. We have that. The second thing we talk about is you getting to retain the power of where your money's invested. We do not have that here with this loan rate. And they're telling us right here, hey, if you choose this indexed loan account, we are going to take that money and we are going to put it into the indexed loan account, which is the S&P index with a 9.75% cap. So you don't get to choose the actual investment underlying the performance. You don't get to choose the hedge on this policy if you choose the indexed loan account. And the reason that this matters is because these caps, these rates are separate from the other rates on the policy. So you could be in a situation where everybody that's chosen the indexed loan now has different caps than all the people who don't have the indexed loan. And very rarely does a company set that up that way to reward the policyholder. Most oftentimes they're setting the policy up that way to give themselves an out if rates move against them and they have to lend you money at 6%. This is why they're doing this, so pay attention. This is convoluted. If they know that they have to loan you money at 6% and they can earn more than 6% in the bond market, they're losing money every time they loan their policy owners dollars. If they can earn 7, but they have to take their money and loan it to you at 6, they're losing money. And so the reason that they dictate where your money gets invested is because they can adjust the caps lower to make up for the money they're losing by loaning you dollars at a lower rate than what they could earn in the market. A lot of companies are going this route, and it's a route that I would prefer they didn't go because, again, they're giving us variables that are hard to account for.
Right. Yeah, and I think it is interesting that they're kind of doing one thing right and one thing not necessarily right for the policyholder. And again, the 6% loan rate, you can say that's good, you can say that's bad, but really what we like, you would say, is the fixed part.
That's what's important. We know what it is. We can account for it. And I wouldn't say that this style is good or bad. The only reason it's bad is because there are companies who don't do it. If everybody did it this way, then okay, it is what it is. But you wouldn't go out and choose this way of doing business because it doesn't give you any added flexibility. It takes flexibility away from you.
Right. You lose the decision-making power in a sense. And I think that's why we like to give you enough information in terms of carrier knowledge to make a good decision here. Because like I said earlier, if you're viewing this in a vacuum, this might look good to you. It might be good, but we have to compare it. And that's obviously a moving target, but this is worth looking at, especially keeping up with it and doing reviews like this. So
yeah, I hear what you're saying, Brady. Like every carrier does this different.
Right.
There's no one way to do these products. And that's why you have to compare these products side by side. They all have different contract language. They all give you different outs. They all work a little bit differently. So you can't just look at one thing and know whether it's good or bad. You have to compare to what else is out there and available. What's next that we want to talk about on this Penn policy?
Yep. So, we could look into a lot of different things in each contract, but I think those two things were mainly the biggest questions that we had in terms of for the goal being maximum cash growth and income. We want to see what the indexes are. We want to see what the loan provisions are. We want to see are those provisions favorable or not. We could get into fees. We could get into carrier performance in the past. But overall, I think we hit on the two big things. So I think the last question that I have about the product is, overall, is this a preferable product to generate maximum cash and income later in life, long term?
I think that this could be a preferred product for maximum cash and income if there weren't other companies that did things slightly better. Penn as a company is a phenomenal company, very highly rated. They have some good policy provisions in here. All their bonuses seem to be guaranteed and factored in. Their loan rate is guaranteed and factored in. They just don't have the diversity of their index options. And you don't get to control how your money's invested once you use that indexed loan. So I would say unless the rest of the industry really takes a huge step backwards and Penn stays where they are, then maybe they would kind of move to the front. But as it is right now, since there are other options that give you more flexibility, more options to choose from an indexing strategy, more flexibility with how that money earns the credit, I would say right now, unless they're just giving you a home run of a deal, there might be better options.
Yep. And I think that's to your point. It's valuable to work with people who don't just work with one carrier.
Yep.
So I think that's kind of a big takeaway here is, yes, it could be but it's not at the moment.
Yeah. If you are currently considering a policy that's like this, a policy from Penn or any other index universal life insurance company, and you haven't seen any comparison done to what else is available, I'd encourage you to reach out to us. We can do that for you. We don't charge for it. We just ask that, if we provide the best solution for you and you like us and you like doing business with us, that, you give us an opportunity to earn your business. So you can do that by going to our website, leveragedwm.com/contact-us. We'll put a link in the description as well as a little call out card above. You can click on that. It goes to our website. You take a real quick quiz, and that just kind of gives us an idea of what you're looking to do. And then we book a quick 15 to 30 minute discovery call with you and figure out how we can best help you out. So if that's something that you'd be interested in doing, certainly take advantage of that. We do about 750 policy reviews every single year. We've saved over $60 million in fees, and we've increased lifetime income on these policies by around $80 million just by the people who decide to work with us and go through that policy review process. So if that's you, we'd love to connect with you. And if not, hopefully we'll connect with you sometime in the future. Until next time, take care.